One story that we've been talking about, certainly here today, is this Black Sea grain deal, which has now fallen apart. So Russia ending the deal. It is a deal that has allowed Ukraine to export grains. Megan Durisin joins us now. She covers this story. She covers food and agriculture out of Europe. Megan, talk to me about the implications of what is happening here. You end this deal, then what?
Yes, so the deal, this is almost a year after it was first agreed, and there's been a lot of success. There's been more than 30 million tons of crops shipped. Wheat prices are about half of what they were last year. Now, this is going to jeopardize that key trade route from Ukraine. Ukrainian officials have said they're interested in keeping Black Sea shipments going, but it's all they're asking for assurances from Turkey and the UN, so it's a bit unclear what's going to happen there. For now, a lot of the Ukrainian crops are going to be pushed towards the river ports, towards the border with the EU. Grain is moving out that way, but it's expensive.
And that's going to mean higher prices?
Well, it could be. And it could also mean, Ukraine farmers are going to be planting their next wheat harvest in just a couple of months. They might plant less if those costs remain very high.
Megan, great stuff. Thank you very much indeed. Megan Durisin on what's happening with the grain deal that's fallen apart. Mark, this is the threat, isn't it? We're kind of assuming now that we have the disinflationary forces that we saw at play in the CPI number out of the United States last week, and they continue. The market seems to be extrapolating that the Fed can land the US economy, that inflation is going to come down and come down relatively gently from here. What are the risks at the end of the year that we see a re-acceleration, food price inflation, a whole range of inflation metrics starting to re-accelerate, and that the Fed has to hit the brake again?
Yeah, I think that's a real risk. We highlighted that at the beginning of the year, called the head fake scenario, which is inflation falls from 9% highs, but then it starts to get stuck around the 4 or the 3% level, and the Fed can't be done, and that remains a risk. But all these things, Ukraine, the VIX is back to pre-crisis or levels we haven't seen, say, in several years, right? 14, 13, something like that. So any one of these hiccups, it's almost like Ukraine's been forgotten. So that could cause a repricing along the way as we get into the back half of the year.
Well, as you talk there about the idea of us maybe getting stuck at 3% inflation, Mark, do you think the Fed would take that as an answer, that it will actually be okay with them if we don't get back down to 2? Can we live in a 2% world post-pandemic?
Well, one of the things that we've seen from this Fed is a lot of crisp prevarication about things. I mean, I do think they try to be very crisp and clear about having a reaction function, but then very fungible about whether inflation is temporary or lasting. And to be fair, I don't think the long-term inflation expectations have crept up that much. I don't think the Fed is ever going to admit that they've moved off their 2% target, but they may say that we're along the way and they're comfortable with the pace.